For our next segment, we will explore if leasing will be the big thing for India. As the moderator, we have Mr. Mohit Saraf, founder and managing partner, Saraf and Partners. Mr. Saraf leads the company, one of India's fastest growing law firms, and is widely regarded for his work in the hospitality sector. Joining him on stage are Mr. Aditya Sharma, country head Sunday, Dancenter and Weddings.in, Mr. Manoj Bhat, Managing Director and CEO, Mahindra Holidays and Resorts Limited, and Mr. Neelendra Singh, Managing Director and CEO, Lemon Tree Hotels. Please give them a round of applause.
Good afternoon. I think Manav did a trick. With all the awards, we got a lot of you inside the conference room because we were all worried that everybody seems to be outside than inside. So thank you, Manav, for that. I think traditionally, if you look at the hotel industry, most hotels were owned, operated, the land was acquired, they were built by the owners, and they were operated, be it Oberoi's, be it Taj, be it ITC, particularly in the first 50, 60 years of our independence. But in last 10, 15 years, we see a lot of, I think, emphasis of stock market on asset light model, and with a lot of these international brands coming to India, we've started seeing a lot of management contract. And I think the critical question for us here to deliberate is how important is leasing going to be there for next few years? Particularly, will leasing be an area of growth? If you look at numbers, for last 2-3 years, additional keys from hotels, almost 81% of it has been from management contract. But one of the sessions which I was hearing just prior to this session, I was told that, okay, the best Western, 50% is management and 50% is franchise. In Hyatt, it's probably 10% is franchise and 90% is management. And that is, at Radisson also it was 50-50. I just was quite surprised to hear that. So I think the critical question for us to examine is how relevant would be leasing as an engine for growth for next few years. I would say, why don't I give, just to introduce, I think I forgot to introduce myself. What I can do is request everybody to introduce. I'm Mohit Saraf. I'm a managing and a founder partner of a law firm called Saraf and Partners. And I really work very closely on the real estate and hospitality sector. I think Aditya?
Yeah, hi, good evening everyone. I'm Aditya Sharma. I'm representing Prism today. Prism has multiple business units. On the affordable side, we have a brand called Oyo. All of you are aware. On the premium side, we have a brand called Check-in Sunday. So I lead the Sunday mandate for the company. We also have a brand called Weddings.in. We are one of the largest aggregators of banquet in the country. We do 11,000 social events in a year. And then we have a brand called Innovate, which is in the co-working space. So I am representing Prism today, right? But I lead the Sunday mandate for the company. I've been here for 8 years now. Yeah, thank you.
Good evening, everyone. I'm Manoj Bhat, and I'm heading Mahindra Holidays. And many of you would know Mahindra Holidays as a membership model, but I think the transformation we are doing today is we are becoming more a mix of, or a hybrid model between member and non-member. That's the transformation journey we are on. The second thing is we have announced another brand, so that's in the pipeline. So I think from our perspective, we are about 6,000 rooms. Just for context, about 50% are owned, 50% are leased. And I think from an overall change, I think the new brand is what I think we will probably explore management contracts more with. But I think for from our perspective, leasing just works better because of the visibility we have.
Hi, everybody. My name is Neelendra. Like I say, I'm the latest intern in the industry. I'm only 6 months old, so go easy on me, please, Mohit. I represent Lemon Tree. Lemon Tree, probably the largest mid-scale operator. At this point of time, we have 130 hotels right now that are operating, 130 hotels in the making. That makes it almost 11,000-ish rooms that are currently operating and about 10,000 rooms in the making. So 20,000 rooms, give or take. And I was just calculating how much is leased and how much is managed. About 10% is leased and 90% is largely, let's say, managed in that sense. So lease light and lease heavy on that side, please.
I think, Aditya, let's start with you. Particularly, I think, since you manage different formats, your country head for different formats, from premium hospitality, premium stay, to co-working, to wedding. Now, in these various formats, how relevant is particularly leasing for you?
Right. Thanks, Mohit. Again, like I mentioned, we manage from budget to premium to weddings to the co-working spaces. What Mohit we have seen is there is a lot of variation in the expectation of owners throughout. Today, if I talk about the affordable segment, we add approximately 150 to 200 hotels in a month on the affordable side. When we started this journey back in 13-14, it was majorly driven by leases. But as we move forward, we were able to show consistent return to our partners. Today, very, very happy to share that in the affordable segment, our management contract is growing 2x of what we were doing last year. Today, we do 30% of rev share deals in the affordable segment. The second is the premium segment, which is the Sunday hotels. Very glad to share we have 55 hotels signed in India today. Out of 55, 50% are on management contract, 50% on our revenue share MP. There are no pure leases, and that's also driven by market because most of the players here have been doing management contract. But what we are seeing as a trend is there are a lot of new people coming in the hospitality side, and their expectation is to protect their base income. And hence, there's a revenue share MP expectation they have. The third, we have weddings. Weddings is one business wherein, so on the premium side, we are seeing a mix of management contract and revenue share MG. We are seeing in tier 1 location, that's where the revenue share MG leasing, as you say, is more dominant. In the tier 2, tier 3 locations, still people are okay with management contracts. I think it is also a function of age of the company in this premium segment. We have been there in the premium segment for 5 years now. As we grow, as we expand, I think people will realize that we will be able to demonstrate superior returns again. And again, I think we'll move towards more of management contract and less of leasing. The third is a weddings business, which is a very banquet-driven business. The owner's expectation there is predictable income. Weddings is a very, very seasonal business. And I think one of the things they expect from us as a brand is if we can give them consistent income. So weddings as a business is dominantly leasing as of now, right? We do not see revenue share. We do not see management contracts as of now. We do a lot of franchisee there, but we don't do any management contracts as of now. Innovate, again, is a co-working space. We are we are 5th largest player in the country right now. We have 52 centers across India. And it is still dominated by leasing because most of the players are doing leasing. It is more consistent business. Once a client he locks in for a couple of years. So the owner also expect consistent returns, unlike hospitality, wherein there's a bit of a variability, which is a seasonal variability.
Do you see that because of religious consideration, certain people prefer to do banquets on leasing so that they are not involved in what is being served inside the banquets?
No, very nice. In fact, we have a use case recently, Mohit. So there's a builder where we have signed 117 rooms in Khopoli in Maharashtra. And it's a Jain builder. So when they came to us, they had a very, very different ask. They said, we are okay to do a management contract, but we don't want any income from F&B. We don't want any revenue share, any involvement. We just don't want to be involved in it, right? So the peculiar ask by this builder was, I'm okay to do a management contract on rooms, but I need a lease on F&B because I don't want to be involved in income. And they also shared that they have also done a similar arrangement with one of the other brands. So eventually we kind of deliberated in terms of how the operational nitty-gritties will work, because it's a very complex system wherein rooms are driven on management contract and F&B and banquet is driven on lease. But we figured out to the last mile saying that these are the scope of work, this is what is in your scope, this is in our scope. There was a bit of a back and forth, but all of us realized that this is the best way to go. So we just closed 117 keys wherein Jain builder doesn't want F&B income and he wants lease on banquet and F&B and he doesn't want it on rooms. So thanks for asking this here.
Similar thing, I think we often do a lot of interesting financing, and particularly Islamic financing, where you typically can't lend and take interest income. But every time we do a structured deal, the lender actually takes everything away, but it's structured differently. But here it was a little different, that you took the income, you just took the rentals, you just paid the rentals.
Yeah, Mohit, just to add, we are also seeing a lot of REIT players coming into hospitality. Yeah. REIT is where they expect predictable returns, right? And again, the revenue share MG format kicks in there.
When you use the word revenue share, it is basically what you're saying is it's a rentals, but you give minimum guaranteed, but you do more revenue share. So it's a lease.
Revenue share, I'll say, is a hybrid model. It's fundamentally a lease model only. It's a hybrid model. What it does is it protects your downside, and it also gives you an opportunity to, if you do well, there's an opportunity for you to score well as well. We're seeing increasingly demand for revenue share MG, especially in tier 1 locations, because what the builder wants is that his downside should be protected. He can give returns, predictable returns to people, investors, etc. And his upside, if we do well, it should not be capped. We recently did a sale and leaseback model with one of the top builders in Gurugram. Again, you know, in this case, they had sold the entire inventory to multiple stakeholders. This was also a tricky deal for us because we were entering the sale and leaseback model for the first time. Gladly, everything worked out for us. We had to give some MG there in order to kind of, convince the 217 owners who were there. And eventually, we were able to convince them with rev share MG model. So I think hybrid model with the new REIT structure coming in, the new SLB model coming in, I think we are seeing increasing demand from the new age builders. I'll not say the old builders because they understand the advantages of management contract, but the new age builders is what we are increasingly seeing from them.
So Manoj, moving on to you, you are one of the few people on in this whole conference who are not looking at customers who buy rooms, but you look subscriptions or membership. And once you get membership, your revenue works. So how does that entire structure works, particularly with the lease model? Because when I've seen your property in hill stations, in remote areas, I feel that largely when you set up the hotel or the hospitality center, there's virtually nothing there. And therefore the land cost must be very low. And therefore, typically in places like that, you would not end up leasing a place. You'll just buy the place because it's pretty cheap, and then it grows up as your ecosystem grows up. So how does it work? And since you say that 50% of your properties are leased, give us a little bit more color.
So Mohit, I think the journey of the company was really, as you said, beginning with memberships, and initially, like you said, I think we were going into remote areas, and one of the thought processes there was that can we keep discovering new destinations for our members? And I think if most of our resorts probably would have been the first one to come into that location. The second part of that was that initially we built it out because we wanted to get a feel of what we are trying to build as a brand, but over a period of time, I think as we expanded, what we found out was there are a lot of individual owners or individual people who want to partner with a brand like ours and prefer the leasing model rather than take the risks and reward of any other model. And the third part is, of course, because we have an member base, I think there is a predictability on occupancy. We know all the patterns, we have the historical data, we can accurately predict almost to a few percentage points what the occupancy would be for any new property. And generally speaking, a new property in the second or third month or fourth month, we would see 60 to 70% occupancy climbing up. So there was a kind of all these indicated that the leasing model is a much better model because you have more control over the customer experience. You have owners and partners who want that kind of income stream. And of course, backed by a brand which they feel that is something which is very, very good. So that was the history. And where we are today is, of course, we still have membership as a model, but we also are encouraging non-member business. So I think the model is shifting, and I think as we are expanding, I think we are also exploring, I think Aditya spoke about hybrid models. So we are exploring that very actively. And as we introduce our new brand, which will be in the course of the next 12 to 18 months, I think that will be more of a conventional, probably a brand which will then open ourselves to a management contract. So our objective here is, if there is an owner or any developer, we should be able to offer the full spectrum. And depending on the destination, depending on the situation of or the kind of a need of the location, I think we probably want to be offering the full suite. That's the way we are thinking about how we build the brand.
So Neil, coming to you, since only 10% of your business is on lease, so we'll leave that for a minute and talk about, I think there have been a big corporate restructuring for you. I think initially Lemon Tree was an asset-heavy model. A lot of properties, you bought the land, you got the permits, you built the hotel, and you ran it. And particularly, I think effective 1st of April this year, there is now an OpCo, and which is the operating company of which you are the CEO, and there is a PropCo which owns the properties and now you manage it. So tell me a little bit about the entire journey, the reason, and you can share, because there are a lot of owners here, and they can get some guidance from you.
Sure, thank you. So I'll try and simplify this as I've understood. So 130 properties, of the 130 properties, 41 are owned. I think that's the split. The others are managed. Now, because we own properties and we manage properties, the valuation that we give actually or get is a sum of the parts. It's because our revenue is a function of the hotels that we operate and the fee income that we get from our third-party managed hotels. Now, traditionally, I understand in the hotels world in the West, this is an oft-played, let's say, playbook where there's an OpCo and there's a PropCo, so that the risk-return profile of each company is different. So what we're executing right now, Mohit, is actually what has been executed many times in the West, in far mature markets, where we transferring our 41 hotels, or let's say the hotels we own, to a ownership company, and therefore the debt and the asset falls on a new company called Fleur, which will ultimately go through an automatic listing route, and therefore the valuation that Fleur gets will be of that of a real estate company. Let's go this way. Whereas Lemon Tree will be managing all the hotels that belong to Fleur and all the third-party hotels that we anyway manage. So for Lemon Tree, the income therefore is just the fee income with no asset and no debt. And essentially that multiple traditionally is far higher than the real estate multiple that you get. So what today is let's say a sum of the parts multiple that the company gets tomorrow will be a very distinct, transparent multiple, one of a real estate company and the other of a fee generating company. And therefore as a shareholder, one can choose to be on either side or both sides and enjoy a different risk return profile, basically as a shareholder. Also it releases value for the properties that we own anyway. And the other thing I would like to say is fundamentally because we become light, like Manoj said, we typically now are free to do or go faster, which is, I guess, the mood reason of going light, that you can now deploy your energy on rapid expansion and go to places where, let's say, one could not have gone because one had the weight of all the assets in the balance sheet. So interesting juncture for Lemon Tree for sure, and therefore I also believe we would be the unique only fee generating listed company in our space as of now. So clearly a pivotal moment.
Let me ask you a follow-up question. If you look at Indian market, most of the big hotel companies, whether it's Indian Hotel, whether it's Oberoi's, whether it's ITC, they have ownership and management all sitting together.
Yes.
And what you explained is that it really gets you a better valuation. You have debt-free, Your markets doesn't give you a holding company discount because assets do not get valued in operating businesses. So I think, and you are one of the youngest CEO, so give us your perspective. I think what you've done, probably there would be similar structures, could be a similar structures in other asset-heavy companies.
Yeah, why not? I think, I mean, and intellectually, again, I'm still understanding this space, but there's a point in our history, and this happened to, I guess, most of us, most hotel companies in India, there's a point when we were ownership heavy, and fundamentally there was a pivot point when we start looking at scale, and therefore there's more value to be derived from ownership and scale. So traditionally, I mean, we were ownership heavy, and therefore there was no point doing anything like this. But today, we only own 41 of the 130 hotels and potentially 50 of the 260 hotels that we eventually have in the next 36 months. So, and I guess as most Indian hotel companies which are ownership heavy expand and become management contract heavy or get a better balance, this might not be a bad route at all. I mean, it happened to everybody in the West anyway. So it's I guess it's a very common playbook.
No, I agree 100%. I remember when the REIT structure came, and I was comparing one of the HVS schedule conference number of years back, and I said, okay, should be the structure, but only except you, none of them have followed it, and that's the reason I asked that question. So Manoj, let me ask you another question. Because 50% of your property is leased whole, lease works very well in upcycle and have challenges which everybody has faced in downturns. How do you really create a resilience because of the fixed income issue or fixed payment issue in a leasehold property ownership structure?
Sorry, could you repeat that?
How do you create resilience?
Okay,
so
resilience.
That, yes.
So I think, as I was explaining in the beginning, right? So our journey here has been unique in terms of the visibility we have, right? Because of the member base, we have about 3 lakh members, and typically we would see them use up a lot of the capacity. So from that perspective, the balance which that brings in, and that builds a little bit of resilience in the model by definition, because I think we are seeing most of our members are repeat visitors. Most of them would like to explore new locations. So I think that gives us some comfort is from a business model perspective. But if I see the journey going forward from here, and that's where we are probably going and exploring different models around hybrid, whether it's a rev share with a minimum guarantee or potentially the new brand with, and so if I think about the history so far, yeah, that has given us that ability and the inherent resilience. Even during COVID, for example, our business, maybe it was just impacted for a few months when travel was not really happening, but really as soon as it opened up, I think we started seeing occupancies build back very, very quickly. And that's, so to me, there are 2 phases, and that's the transformation we are going through, that so far this model has worked very well for us, and we are happy to offer it, because I think that the member base which we have will continue to remain. But as we go incrementally more into non-member business, I think the new models will probably play up. That's the way at least I see it.
I remember Manav doing a session with Bill Henneken, and he was here, the head of Minor Hotel. And one important thing which he said was that I did the largest M&A deal and spent $3 billion out, and then COVID happened. And then I incurred loss of $1 billion. So typically, what he said is, for me, the asset came at 4 billion, not 3 billion. And I think that's really a downturn issue and an upcycle issue. But really, coming to you, Aditya, at a property level, does a leased whole property feel different than a managed property?
As we are, Mohit, as we started the journey for Sunday, in fact, the journey started a couple of years back, 2000, and I was sharing it with Mohit, 2019 is when we started acquiring hotels. We acquired our first hotel in Jaipur, followed by an acquisition in Zirakpur, followed by Baroda and Ahmedabad. Initially, it was very, very important that the entire thinking around Sunday should also be communicated to the consumer, to the end consumer, and also to the owners. And it was imperative for us to ensure that we keep a very, very tight leash on, have a very strict SOPs. We do not let go of the quality of the property, the repair and maintenance, everything is spick and span. So to answer your point, Mohit, when we started, we also had a preference of doing revenue share deals, revenue share, not revenue share MG. Revenue share MG is hybrid kind of a lease, revenue share is still not lease. The preference was revenue share deals so that we have tighter control on the operations, the consumer experience. And of course, these assets can also become the showcase assets to the new set of owners who can look at it and understand how we operate. So initial thinking was this: as we are entering newer cities, we prefer this model. We call it hub and spoke. We prefer to have one revenue share MG hybrid deal depending upon the location. And then in and around it, we can have the management contract deals, etc. around it. Just to give you an example, Mohit, our success has also been on the similar lines. The first management contract property we had in Mohali, which was very, very close to a Zirakpur hotel. So the owner came, saw the process, saw how we were driving it, and it was an easy win for us, right? So to answer your point, yes, we prefer to have revenue share deals more because we feel experience can be controlled with the help of revenue share deals.
So now we go to rapid fire, and everybody has just one word to answer. And we start with you, Neil. Yeah. Which city in India do you believe leasing will outperform?
Delhi.
Delhi? Next.
I think I will answer it differently. I think not in the cities. I think as we see the tourism wave move further, I think that's where I think leasing will work fairly well.
Aditya?
No, I think the metros, because the real estate has become very, very expensive there. So I think Delhi, Bombay is where we see this happening.
Typically, I think I've been working on the lease models with a number of operators. What I see is in places, smaller places, mid cities, where average room rate is between 4,000 to 8,000, where there is a high-tech city. These are the places where you have a lot of working population, different industry, supply is not coming too much, there's a limit sheet. Same thing happens with Aero City. That is where you see a little bit more expansion of lease. Next one. One mistake, we start with you, Aditya. One mistake which operator make in leasing negotiations.
I think it's one word, okay. I think product market fit. Product market fit, as in the product has to be absolutely in line with the expectations of the market. We have been to a lot of assets wherein...
One line, Manoj.
Product market fit, yeah.
I would say, I think there's a balance between brand standards and conversion of existing. I think that's one area where I think, at least in my 2.5 years, I think I've seen that as one area where the most disputes come up, and that's something really, if we have clarity, that will help.
Neil?
Yeah, I don't have enough experience here, but I would say not going for a win-win for the landlord or for the owner-operator, just hoping one party wins and the other loses, that won't work.
Fixed rental or revenue share?
Depends.
Depends.
On the location.
I would also go with depends, because I mean, to me, as I said, we have to offer choices to both owners and developers, as well as make sure that from a customer perspective, we're meeting the promise we are making.
Yeah, revenue share, hands down.
Revenue share, hands down. Now start with you. I think that basically the topic of the session is, will leasing become a dominant factor? Yes and no?
No.
No.
Healthy equilibrium between leasing and management contract.
Not dominant.
Not dominant, 50-50. Yeah.
So I think we are a little ahead of time. Leasing is not becoming a dominant factor in some time to come. And I think, so we have some time. We've done it. Typically lawyers always spill. They never complete their brief in time, but we are ahead of time, so we'll take some questions. Yes, please. Any of you?
Let me take a shot at it. So one of the reasons I said not in cities is because that's going to be one of the comparisons as you think about a leasing. And the return expectations from most investors, developers, I think there is going to be a mismatch. But the moment you go outside, I think that outside the main cities, I think that's where I feel leasing will be continue to be relevant. And then it's a balance of risk and reward between the operator and, but in the cities, I do believe that issue will come up for comparing a commercial versus what is an expectation for a port.
And just to add, one of the key challenges we face with a lot of new builders is they look at us from a very retail perspective. They are very focused on per square feet with capex, without capex, right? I think it takes a lot of time for us to explain them that, hospitality income grows with time. On day one, it doesn't happen, right? And it takes 3 to 4 years of stabilization. So there's a lot of effort which goes there. They do not get convinced so easily. So when they go and speak with few more people, then they get convinced and they come back to us. Yeah?
Any more questions? Okay. So I think just to conclude, I think the entire discussion and the way forward, I would say by ownership, you build assets. By management contract, you build brands. And leasing is more about building judgment. I think probably. And thank you very much. I think we had a great discussion and we've been within time. Thank you.
Thank you.
Thank you, gentlemen.